right, so here we have an online tool for calculating investment, investment growth, dividend growth, you name it. There are tons of them. This is one that I like because the interface is quite simple. And here we're going to play around with a stock that I enjoy. It's CNR or CN Rail. It's a Canadian railroad company. I like them, well, because they've been operating for a long time. They have a history of being profitable, of dividend payouts. And let's face it, their economic moat is pretty large these days. There's not a lot of new railroad companies that go out and lay actual rail to own. And there's really not a whole lot of market destabilization. The internet's not threatening how we transport heavy freight goods across long distances over land, right? Same happens in the ocean. I just happen to like this one because I like trains, I guess. Okay, so the price of the share is $171. I had to put number of shares 1 here, so we assume we start at 1. A holding period of 10 years. The annual dividend yield right now is at 2.01%. We're not going to contribute just yet. The dividend tax rate, I'm going to leave at 0 for now. We're going to assume that this is going into a Roth IRA or TFSA where it's sheltered from taxes. We can play with other rates after. The rise in dividend payout. So in the case of CN, they have about 5% increase averaged out over the years. So every year they increase by about 5% on the dividend payout. And then they have a expected price appreciation of about 9.3. Now I went conservative with this one. It's probably more around 10.5, but for the last 5 years, they're a bit slower given all the economic stuff that's been happening. So 9.3, we took the conservative side as opposed to a more favorable one, okay? Now, obviously on one stock, that's not a whole lot going on, but here, let's say we had, let's go with 300 stocks. So that would be a starting investment of 51,300 Canadian. What happens there over 10 years is you basically triple your money. So if you're able to delay gratification on this 51,300, you triple your money in 10 years. Not bad. But let's take a look at, are you able to delay gratification for 20 years? You just 10x'd. Pretty good for, a company that just operates itself. You invested once, you never looked at it again, and all you're doing is waiting at this point. And true, the past is not always an indicator of the future, but this company has a very long-standing record, so it's pretty robust. If there's one that I would trust, it's definitely this one. Otherwise, you could also repeat this with an ETF. But let's take a look first at what happens if you delay for 30 years. So that's, I'm not even counting the X's anymore because I can't do it that fast in my head, but it's almost 5,000% return. So again, your initial investment was only 51,000. Well, it was 51,000. Because I anticipate that a lot of people will say, Randy, I don't have 51,000 to invest on something straight up and wait 30 years. Never mind the wait, I just don't have the money. And that's okay. All right, so we're gonna repeat it. But this time we're starting with 0 or near 0. I have to put 1. And we're just gonna contribute an annual amount. And I'm gonna pick this amount. You're probably not gonna like it. But for me, it would be this much per year. And let's start over at 10 years. Now you're gonna see them, they're gonna graph out disproportionately because you're not compounding on 50,000 right away. You're only doing on 6,000 in the first years. So there's going to be some inherent slowness at the beginning. And the reason for 6,000 per year, it's 500 a month. Yes, it's high, but you have to be prepared to give something up if you want to get something, right? So in this case, you're going to delay gratification on that 500 every month to see what happens. So over 10 years, you're going to be at 100 grand or just over, which is not bad for 500 a month. 100 grand in 10 years. It's potentially a long time, but it's a heck of a down payment, depending on how you're looking at it, where you're coming from. And no, obviously, if you work minimum wage, I don't expect you to minimum wage full-time. I don't expect you to be able to put 500 away unless you're living with your parents or doing something crazy to save money, because it's like, you know, almost half of your net take home. Let's see what happens after 20 years. Almost 500,000. So you can see here now it's catching up, right? The earlier numbers at the 10-year mark on 50,000, we were here. Now it's 20 years at 6,000 a year, but we're at the $500,000 mark. And if you can delay gratification for a total of 30 years, and granted, over a 30-year career, you should be able to increase this contribution at some point, but after 30 years, it's at 2.3. So we had 2.5, I think, earlier. This close enough for me. So you can invest 50,000 now, never invest again, let it run for 30 years, or you could invest $500 a month, 6,000 a year for 30 years, and you kind of end up at the same place, all right? So pretty fun little math exercise to do. I would say you should probably not be below $250 a month, no matter what, right? It should be 10% of your take home at any given moment as a bare minimum, and I would say $250 on the flip side of that if you want a hard number, which would bring you to $3,000 per year. Now, obviously the returns are less, but it's still 1.1 million. I think that's pretty good for deferring gratification on $250 a month. I think it's actually quite worth it. Again, I did it with CN Rail in this case for no particular reason that I like the longevity idea behind the company. You could take a dividend ETF like Schwab, or the I think DVI is the S&P dividend payer. VYM for Vanguard, they also have a dividend-based ETF, which will actually have better numbers in quotations for, you know, dividend growth and annual dividends, because that's what they're built about or based on. So there you have it. All right, guys, thanks for watching. Please subscribe.